Did you know that even the most experienced investor can see their profits disappear by not following a golden rule? That rule is diversification, and today I will show you how it can be your best ally or your worst enemy in the world of investments. Diversification is more than just a financial term. It is an essential strategy for any investor looking to protect and grow their capital. However, like any powerful tool, if used incorrectly, it can lead to disastrous results. In this video, we will delve deeper into the art of diversifying your investment portfolio. Not only will you learn how to allocate your assets effectively, but you will also discover the common mistakes you should avoid to avoid putting your investments at risk. These tips will help you make more informed decisions and keep your portfolio on track for success. Before we dive into these financial secrets, if you find this type of content useful, I invite you to like and subscribe for more investment advice. And now, get ready to learn how to diversify your investment portfolio intelligently and sure. Let's get started. We begin our journey toward a successful investment portfolio with a fundamental question. What is diversification? In simple terms, diversifying means not putting all your eggs in one basket. In the world of investing, this translates to spreading your capital between different types of assets and investments to reduce risk. The idea behind diversification is simple. By investing in a variety of assets, you can mitigate the negative impact if one or more of them decline in value. For example, if the stock market is in decline, your investments in bonds or real estate could offset losses. It is a strategy that seeks a balance between risk and return, taking advantage of the fact that not all markets move in the same direction at the same time. Diversification can be done in several ways. One is asset class diversification, which involves investing in different types of assets such as stocks, bonds, real estate, and perhaps cryptocurrencies. Another is geographic diversification, where you spread your investments among various markets or regions of the world. There is also diversification by sector or industry, which focuses on investing in different economic sectors not related to each other, such as technology, health, or energy. The main goal of diversification is not to maximize returns, although that can be an added benefit. The real purpose is to minimize the risk of large losses. In an ideal financial world, we want to avoid situations where a single bad investment can devastate our entire briefcase. It's important to keep in mind that diversification is a long-term strategy. It's not about avoiding all losses, but rather smoothing out fluctuations in the total value of your portfolio over time. In the short term, there will always be ups and downs, but a well-diversified portfolio is designed to weather financial storms and capitalize on opportunities in different markets and economic conditions. After understanding what diversification is, it is crucial to explore why it is so beneficial. A diversified portfolio is not only a prudent recommendation, it is a strategic tool that provides multiple advantages, especially in risk management and optimization of returns. The most significant benefit of diversification is risk reduction. By investing in a variety of assets, you minimize the impact that a negative return on a single investment can have on your overall portfolio. For example, if the stock market experiences a decline, your bond or real estate investment may not be affected in the same way, thus balancing out the losses. This is especially important in situations of economic uncertainty or market volatility. Diversifying also means opening your portfolio to different growth opportunities. Some markets or sectors can experience growth even when others are in decline. Diversification allows you to capture the benefits of these rising markets, which may not be possible if your investments are concentrated in one place. A diversified portfolio helps you find a balance between risk and return. Some assets, such as stocks, can offer high returns but with greater risk, while others, such as bonds, offer stability with more modest returns. By combining different asset types, you can design a portfolio that aligns with your risk tolerance and financial goals. Diversification also provides flexibility and adaptability. With a diverse portfolio, you are better prepared to make adjustments in response to market changes or your own financial needs. This allows you to change your investment approach without having to make drastic changes, which is a great advantage in long-term financial planning. Additionally, a diversified portfolio can offer some protection against market volatility. By spreading out your investments, You reduce the chance of your portfolio experiencing large fluctuations due to specific market events. This results in a smoother and more predictable investment experience, which is especially valued by investors looking to preserve their capital and avoid the stress of volatile markets. Despite the clear benefits of diversification, there are common mistakes that can undermine its effectiveness. Avoiding these mistakes is as important as diversification itself, as one misstep could compromise the safety and performance of your portfolio. 1. Over-diversification. The first and perhaps the most paradoxical of errors is over-diversification. It may seem counterintuitive, but having too many investments in your portfolio can be detrimental. This occurs when you add more assets than necessary, which can lead to more complicated management and diluted performance. Instead of adding value, an over-diversified portfolio can result in average returns, defeating the purpose of carefully choosing each investment. 2. Lack of regular rebalancing. Another common mistake is not rebalancing the portfolio regularly. Diversification is not a set-it-and-forget-it process. Markets change, and what was once a balanced asset allocation can drift over time. Periodic rebalancing ensures that your portfolio remains aligned with your original objectives and risk tolerance. Rebalancing helps you buy low and sell high, thus capitalizing on market fluctuations. 3. Ignore the correlation between assets. A critical mistake in diversification is not considering the correlation between different assets. Correlation refers to how different investments move in relation to each other. If all your assets are highly correlated, they could lose value simultaneously, which defeats the purpose of diversifying. The key is to include assets that react differently to the same market conditions. 4. Diversification only in asset classes. Many investors focus solely on diversification across asset classes and neglect other types, such as geographic or sector diversification. While having a mix of stocks, bonds, and real estate is a good start, expanding your investments to different industries and regions can offer greater benefits in terms of risk reduction and exposure to various growth opportunities. 5. Non-alignment with objectives and risk profile. Finally, a fundamental mistake is not aligning the diversification strategy with your personal objectives and risk profile. Diversification must be personalized. What works for one investor may not be suitable for another. Make sure your portfolio reflects your long-term financial goals, your liquidity needs, and your risk tolerance. But don't forget that avoiding diversification mistakes is only part of the process. Implementing effective diversification strategies is the crucial next step. These strategies should be designed to balance your portfolio, adjusting to your financial objectives and comfort level with risk. Investing in different sectors and industries is another effective strategy. Different industries react differently to the same economic events. For example, at a certain point, the technology sector may prosper while the traditional energy sector may be in decline. Diversifying across different sectors can protect your portfolio from fluctuations in a specific sector. It's also important to consider diversification over time, especially if you're investing for the long term. As you get closer to your financial goals, such as retirement, it may be wise to gradually shift towards safer investments. This strategy, known as time horizon, ensures that your portfolio adapts to your changing needs and risk tolerance over time. Before moving forward, if you find this information valuable, I encourage you to leave a like and subscribe. This way you can continue enjoying more content like this. Let's move forward. Adaptation to different market conditions. Effective diversification depends not only on how you allocate your investments, but also on understanding and adapting to changing market conditions. Different types of markets, bullish, bearish, and volatile, require different approaches in terms of diversification. In a bull market, where stock prices are generally rising, it can be tempting to invest predominantly in stocks to maximize returns. However, even in these periods, diversification remains crucial. Don't get carried away by the euphoria of the market. Instead, maintain a balanced mix of assets to protect against future declines. For example, although stocks may be a larger proportion of your portfolio, don't neglect bonds or other less volatile assets. In a bear market, where prices are falling, diversification can help you minimize losses. In these periods, safer assets such as government bonds or money market funds can help stabilize your portfolio. However, it is important to resist panic and not hastily dispose of assets that can recover in the long term. Consider this phase as an opportunity to acquire valuable assets at lower prices, always maintaining a diversified approach. Volatile markets present their own challenges. During these periods, it is essential to remain calm and stick to your long-term diversification strategy. It can be beneficial to have a higher proportion of liquid investments to take advantage of the opportunities that arise with market fluctuations. Likewise, diversifying into alternative assets, such as commodities or real estate investments, can offer refuge when traditional markets are unstable. Regardless of the type of market, flexibility and continuous evaluation are essential. Stay informed about market trends and be prepared to adjust your portfolio as necessary. Once you've established a diversified portfolio, the work doesn't end there. Regular maintenance and review is essential to ensure your portfolio remains aligned with your financial goals and risk tolerance. Financial markets are constantly changing, and what was a balanced distribution of assets at a given time can deviate over time, requiring adjustments. Rebalancing is a key component in maintaining your portfolio. It involves adjusting the proportion of different asset types in your portfolio to return to your original allocation goals. For example, if your stocks have grown significantly and now account for a larger share of your portfolio than planned, you could sell some of them and buy more bonds or invest in other asset classes to maintain balance. Rebalancing helps keep your risk level within desired limits and can contribute to purchasing discipline. Low and sell high. In addition to rebalancing, it is important to periodically review your investment strategy as a whole. This includes evaluating whether your financial goals have changed, whether your risk tolerance has evolved, or whether there have been significant changes in the market or your life that could affect your investment approach. An annual review is good practice, but it is also prudent to evaluate your portfolio in response to important market events or personal changes. Above all, maintain a flexible attitude. Investing is a journey, and sometimes the path can take unexpected turns. Being open to adjusting your diversification strategy will allow you to better navigate changing markets and take advantage of new investment opportunities as they arise. Understanding the theory behind diversification is essential, but seeing how it is applied in real situations can provide an even deeper understanding. Let us analyze real cases of diversification, both successful and unsuccessful, to illustrate the principles in action and draw valuable lessons. Diversification success story. Let's consider the case of Juan, an investor who achieved successful diversification. This investor distributed his assets among several classes, including stocks, bonds, index funds, and real estate. Additionally, he diversified geographically and across various sectors. During an economic downturn, while his stocks suffered a decline, his bonds and real estate maintained a stable performance, balancing the portfolio and protecting it from significant losses. This case highlights how well-planned diversification can safeguard investments even in difficult times. Diversification failure case. On the other hand, let's examine a case where diversification failed. An investor, Antonio, attracted by the boom in the energy sector, invested most of his capital in stocks related to that industry. When the sector suffered an unexpected setback due to regulatory changes in the industry, Antonio's portfolio experienced a dramatic loss. This case demonstrates the risk of excessive concentration and the importance of not getting carried away by market trends without adequate diversification. From these real cases, we can draw important lessons. Successful diversification requires a balanced approach and constant evaluation. It is not enough to diversify once. The portfolio needs to be monitored and adjusted as market conditions and your personal objectives change. Furthermore, these cases underscore the importance of not over-relying on a single asset class, geographic region, or sector. As an investor, I encourage you to apply these learnings to your own diversification strategy. Analyze your current portfolio. Consider whether you are overly concentrated in certain areas and reflect on how you could better distribute your assets to reduce risks and take advantage of opportunities in different markets and sectors. We've been on an informative journey exploring how to effectively diversify an investment portfolio and the critical mistakes you should avoid. From understanding the multifaceted nature of diversification to analyzing real cases of success and failure, this knowledge is essential for any investor looking to optimize their investments and protect your capital. It is important to remember that diversification does not guarantee profits or completely protect against losses, but it is a powerful tool to better manage risk and achieve your long-term financial goals. Thank you for joining me in this video. I hope the information shared has been useful to you and you feel more confident in your investment strategy. Consider subscribing to the channel for more financial and investment advice. Your support means a lot and helps this content reach more people interested in strengthening their financial health. Feel free to leave your questions or share your experiences in the comments. I would love to know how you are applying diversification in your investment strategy. Stay informed and focused on your financial goals. Thank you for watching.